Companies prefer to use more debt than equity to finance their operating and investing. The company's day-to-day decisions are made by board of directors and managers. They stand for the interest of the shareholders. Both board of directors and CEOs, CFOs, their responsibility is to maximize the wealth of the owners or shareholders. They may face the trade-off between the risk and the profitabilities. In general, a common sense is when the risk increase, the profitability also increase. When the risk decrease, profitability also reduce. Companies prefer debt than equity financing because if the company can make more money than the cost of debt, the company can create more wealth for the owners or shareholders. Too much debt will increase the company's financial leverage or debt to equity ratio. The company will have greater solvency risk. This will result in the follow-up debt with greater interest rate. So there is always a critical point represents the favorable financial leverage. Here, let me show you the two scenarios why company prefer debt. So here, two alternatives. Both the total assets $50 million. Their difference is the capital structure. Alternative 1, 10 million debt, 40 million equity. Alternative 2, 30 debt, 20 equity. The second, the alternative 2 has greater debt, or alternative 2 has higher solvency risk. We are given the company has $8 million income before interest and income tax. For both alternatives, the interest rate or the cost of debt 8%, income tax rate 25%. So we just prepare the partial of the income statements. Both earn $8 million income before interest and income tax. And we multiply the debt with the interest rate. So alternative 1 report 800,000 interest expense, while the second report a huge interest expense because the greater debt. Then income before income tax for alternative 1 7.2 million, for alternative 2 5.6 million. Then we multiply the income tax expense, which is a quarter of the income before income tax. Finally, alternative 1 reported $5.4 million profits, while alternative 2 report a 4.2. Based on the dollar amount, you may think alternative 1 is better, right? But think about it from the perspective of stockholders or the owners. We usually use return on equity to calculate a ratio that represents the interest of equity holders or shareholders. So here we use the profits generated from operation divided by investment by the equity holders. Since alternative 1 has lower debt, so it has a greater equity, so $40 million. ROE for alternative 1 is 13.5%. Although alternative 2 has a lower net income, but its investment by the shareholders also lower, 20. So the ROE is 21%, which is a lot of greater than alternative 1. So from the perspective of shareholders, which investment you prefer? Yeah, the alternative 2. Alternative 2 benefits from the higher leverage, greater debt, total investment 50, 30 from lenders, 20 from equity holders. So greater leverage result in a better result. Here it actually hides an assumption, that is, the company's return on assets is greater than 8%, which is the cost of debt. Yeah, you can see the company generate $80 million. Although this is not net income, but it is pretty high intermediate components, income before tax and interest. Why the shareholders are better off for alternative two? The rationale is very understandable. When a company borrow money from bank, the cost of debt is the interest rate. If the company can utilize this fund, generate higher return than the cost of debt, the shareholders will be better off. Okay. Yeah, another advantage of debt financing is interest expense is reported before tax, so they are tax deductible. The next scenario is unfavorable financial leverage. The only thing changed is it reduced the income before interest and income tax from 8 million to 3 million. Yeah, this also indicates the company's return on assets reduced, which will be less than 8%. Even we are not given the value of return on assets. All others, just based on the calculations, you will see alternative two now become inferior. And the reason is for this investment, 50 million total, the alternative two generate return that is less than the cost of debt, 8%. The income tax rate 40% was a typo in this example. It should be 25%. If you borrow money to buy a home, and if the home's price grows like 10% every year while your mortgage rate is 5%, you are better off. Because your return from the investment is greater than the cost of debt. But if you buy a home, cost of debt is 5%, while the price of a home doesn't change, 0%, or change less than 5%, you will be worse off. You incur higher cost than the expected return. So for the favorable financial leverage is only when the company can generate a higher return than the cost of debt, it will keep borrow from the lenders. Companies also report their segment information. Yeah, they break down their whole operation into different segments. So the segmental information provide more useful information for investors to identify which segment is more profitable. When we break down the information, it provides more details. Companies are required to disclose the general information about the operating segment, the information about the segmental profits, losses, and segmental assets. And also the segmental information help investors to reconcile the totals of segment revenues, profits, losses, assets, and other items. It also provides some other interim period information. So here, I borrowed from, this is the information disclosed by the Alphabet. In the notes to the financial statement on the left, you can see the menu. The second one is the revenues. If I click the revenue, you can see the disaggregated revenue reported by Google. So the Google's revenue can be broken down into Google Search, YouTube Ads, Google Network, Google Clouds, and other bets. And we can see Google's majority revenue earned from Google advertising and subscriptions, platforms, and devices. What we learn from this information, Google is actually an advertising company. Google also report its revenue by geography. See here, Google has 4 major geographic segments: United States, EMEA, APAC, other Americas. Hedging gains losses is minor. It also discloses what EMEA represents or APAC represents. In the slides, we can see the example This is a pharmaceutical company. It discloses the revenues from 5 major segments while including one other. The company disclosed the segmental sales, operating earnings, operating income, total assets, so depreciation and amortization for each segment, and capital expenditures. As I just showed you for Google, you can see it reports its revenue by the geographic area, which reports the company's revenue either from domestic market or global market. Companies may also report long-life assets, long-term customer relationships, and other policies in their notes. For example, a company may disclose their information about the major customers who contribute 10% or more of the revenue of a business. This is very useful for financial analysts to provide the outlook of the firm's future revenue growth. But right now, the geopolitics conflicts between United States and China, this may have impact on the company's business relation with their major customers. Because of the politics and the high tariff, some companies may lose their customers from China. So this will have a significant impact on their sales revenue. Nvidia, AMD, and Intel also lose their major customers in China because of the semiconductor sanction. So the information about the major customers also disclosed in the notes.